Welcome to Breaking News to Trading Moves. Today we're looking at a recent move in the energy markets. Specifically, crude oil prices have softened a bit. So our focus is pretty straightforward. Figure out which sectors get a bit of relief on their costs and which ones feel the pressure on the revenue side because of this.
Exactly. The key thing here is the crude price itself. Both Brent and WTI, the main benchmarks, they pulled back after hitting a 7-week high.
Right.
And this happened even though the latest U.S. inventory numbers actually showed a surprise draw, which you'd normally think would support prices.
So what gives then?
Well, what analysts are pointing to is really three things. First, just general profit-taking after the run-up.
Okay.
Second, demand looks a little softer, kind of late-season stuff as we head out of peak summer. And third, this is a big one, there are concerns that Kurdish oil exports might resume.
The Kurdish export angle. That's not just about barrels, is it? There's a geopolitical element there. Why does just the possibility of that oil coming back matter so much right now?
It really boils down to the potential volume. We're talking about hundreds of thousands of barrels per day that have been off the market because of the stoppage, the flow through Turkey. If that starts flowing again, even if it's gradual, it really changes the outlook for global supply in the fourth quarter. It takes it from looking quite tight to maybe just balanced.
And that shift in expectation is enough to bring sellers out.
Precisely. It just softens that near-term outlook.
Okay, makes sense.
Yeah.
So let's trace the impacts. Who are the immediate winners when crude gets a bit cheaper? Transport always comes to mind first, right? Fuel costs are huge for them.
Absolutely. Let's start up in the air. Airlines and travel. Think Delta Airlines, Daily Dollars, United Airlines, UL, Southwest LUV.
Yep.
For them, jet fuel is, well, it's usually their biggest operating cost after labor. So even a modest dip in crude, that gives them immediate breathing room on margins.
And maybe some flexibility on fares, too, especially as we leave the peak summer travel time.
Exactly. It helps as they move into that shoulder season.
But hang on. Don't most big airlines hedge their fuel costs? Does a spot price drop like this actually hit their bottom line right away?
That is a really important point. Yes, they hedge, often quite significantly, maybe 50, even 70% of their needs, sometimes months ahead.
So the benefit isn't instant for everyone then?
Right. For the heavily hedged carriers, the full impact of this specific price drop might be delayed. But, airlines with lower hedge ratios or maybe more flexible hedging programs, they will see a quicker improvement. It could even give them a bit of a temporary cost edge.
Okay, that's a good nuance. It's not always straightforward. Now let's bring it down to the ground. Trucking, logistics, massive diesel users.
Correct. The trucking and logistics sector. Your big names like UPS, FedEx, FedEx, and also LTL carriers like Old Dominion Freight Line, ODFL, they feel this directly.
How so?
Lower diesel costs feed almost straight through to improving their operating ratios. Basically, it costs them less to earn each dollar of revenue.
Which must be pretty welcome right now, given the, let's say, cooler freight environment we've seen.
Very welcome. It gives them a bit more pricing power just when their main input cost eases up.
You mentioned LTL, less than truckload specifically. Why is fuel such a critical piece for them, maybe even more than for, say, a full truckload carrier?
Yeah, LTL is different. They're running these complex networks, picking up and dropping off lots of smaller shipments on the same truck.
Lots of stops and starts.
Exactly. More complex routes, multiple stops, probably more idling time. Diesel is just constantly being burned in that kind of operation. So any saving per gallon, per mile, it really adds up and impacts their route profitability quite directly.
Okay, transport gets a break. Who else benefits? The refiners. The ones turning crude into those fuels.
Yes, the refiners and petrochemicals group, companies like Valero, Marathon Petroleum, MPC, and you can even loop in some chemical players like Dow, DOW, who use oil derivatives as feedstock.
How does cheaper crude help them? They're not selling the crude itself.
Right. They benefit when the price of their raw material crude oil falls, potentially faster than the price of the products they sell, like gasoline and diesel. This difference is the key. The product crack, or crack spread.
Let's make sure everyone gets that product crack idea.
Okay, think of it simply as their refining margin. It's the difference between what they pay for the barrel of crude and what they get for the gasoline, diesel, jet fuel they make from it.
So if crude costs drop, but fuel prices stay relatively firm or drop less,
their margin widens, that crack gets bigger, and that improved margin encourages them to run their refineries at high rates, generating more cash flow, even if the headline oil price is lower. It also lowers their feedstock costs in general.
Okay, clear picture on the winners, mostly about managing those input costs. But every market move has two sides. let's pivot to the companies feeling the pinch from softer prices.
Yeah, this is where lower prices directly hit the top line, the revenue. And we start with the biggest players, the integrated majors and the large exploration and production companies, or E&Ps.
Like ExxonMobil, Sectoral, Chevron, CVX, Occidental Petroleum opens wide.
Exactly. Their revenues are very sensitive to that headline oil price. A lower flat price just means less money coming in for each barrel they produce and sell.
But these are huge diversified companies. How much does a modest dip really impact them? Aren't they somewhat buffered compared to smaller producers?
They are more buffered, definitely. They have downstream refining, chemical businesses, but the upstream production part is still core, and the market watches that sensitivity.
How does that play out?
Well, when the oil price dips and maybe the outlook for Q4 supply looks less tight, it puts pressure on their overall cash generation forecasts. And these companies have been really focused on returning cash to shareholders, big buyback programs.
So if cash flow projections weaken, even a bit, it might make investors nervous about the size or pace of those buybacks.
That's often the concern. It becomes a sentiment thing as much as a direct financial hit in the short term.
Okay. That leads us to the companies maybe less buffered, the smaller, more focused producers, particularly in shale plays.
Right, the shale-focused mid-caps. These are companies like EOG Resources, EOG, Devon Energy, Divian, APA Corp, APA. They're often described as high beta plays on crude,
High beta, meaning
meaning their stock prices, their valuations tend to move much more dramatically up or down in response to changes in the oil price compared to the broader market or the larger integrated companies.
more leverage to the commodity price itself.
Exactly. They often don't have the same diversification. Their growth really depends on drilling new wells. So even a relatively small drop in crude prices can squeeze the estimated value of their reserves, their net asset values, or NAVs.
And NAVs are basically the present value of the oil they expect to pull out of the ground, if that value shrinks.
Then the economics of spending money to drill new wells look less attractive. The return on investment calculation changes. If the price isn't high enough to justify drilling, they might hesitate, maybe defer plans.
And that hesitation, that potential pullback in drilling activity, leads us to the final group feeling the pressure, the service companies.
It's that trickle-down effect. The oilfield services and drillers, your Schlumbergers, ASLB, Halliburton's, HAL, Baker Hughes, BKR. Their entire business relies on E&P companies spending capital.
So if producers get cautious,
If producers decide to defer adding rigs or hold off on new projects because prices are softer, that means less demand for services and equipment.
what's the immediate knock-on effect for the service companies?
Well, at the margin, it can mean they have less pricing power for their tools and services. It might slow down the pace of winning new contracts, especially some of those big international tenders they chase. It just softens the demand picture for them.
And if prices stay lower for longer?
Then that deferred activity we talked about could eventually turn into actual cancellations or reduced budgets for next year. That's the bigger worry down the line.
Okay, so let's try and summarize the picture this price move creates for you. A pullback in crude, even a modest one, seems to set up a pretty clear split. On one side, you have energy consumers like airlines, truckers, refiners, getting some cost relief, which helps their margins. On the other side, you have the producers, the big guys, the shale specialists, feeling immediate pressure on their revenues and valuations. And that flows through to the oilfield service companies who depend on their spending.
That's the dynamic. And maybe a final thought for you to watch. We talked about producers deferring activity if prices soften. What price level, say for WTI, would need to be breached downwards to really spook those shale producers and potentially trigger actual cuts in spending plans, maybe impacting the rig count more noticeably? That's the threshold the market will be watching.
A key level to keep an eye on. And before we wrap up, just a reminder, this discussion reflects the opinions of the author based on publicly available data. It is not intended as financial advice or a recommendation to buy or sell any securities. Please do your own research.